All right, let's get into Jedi options here next. This is our weekly segment we do every Wednesday with Coach Tyler, who is an options extraordinaire. You know, I talk about this all the time. Tyler, you're one of the best options traders and teachers that I know in terms of the content, understanding it, breaking it down in complex and simple ways so people can understand it out there. And we let you have your little playpen here on Jedi options on the Wednesday show. You can dive into complex concepts. You can keep it simple, whatever you'd like to do, but you're going to present a couple of different ways you could play something. Then we're going to give you our feedback on it here, Matt and myself. What do you got today for Jedi options, Tyler?
Yes, I mean, look, sometimes you have a sector that grabs you and says, hey, you pay attention to me right now. It's like, okay, I'll pay attention. Wasn't hard to decide where to focus today in light of our previous conversation, oil breaking out, energy breaking out. Let's play in the energy space. So what I like about having a sector specific discussion is it illustrates that there are multiple ways to capitalize on sector performance on a theme. So we're actually going to talk about three different ticker symbols, three different ways that I think you can play this energy breakout. And so XLE is the energy sector ETF. So we're going to take a look at that and build a trade on that at the end. The pitch here is from a technical analysis perspective. Let me just beef this up a little bit. If you take a look at the weekly chart of energy, this right here is we would call that a cup and a handle, right? Got a little cup, got a little handle, and there's your breakout, right? So you're getting a weekly breakout, you're getting a daily breakout. And that tells you, hey, go find an energy stock to play with. So went through the various, who's who, the usual suspects in the energy sector, trying to find, is there a particular stock that looks either as good as XLE or maybe better than XLE that we can play with? When you play an individual stock, you get typically more volatility than the sector because it's a more concentrated bet versus a diversified bet. So the pitch or the appeal, the hook for going for the individual stock is, hey, I want something that's a little bit higher octane, something that moves a little more than XLE. So two stocks that kind of met the initial, litmus test or just looked good right off the bat. The first one was Kinder Morgan, KMI. And, I'm not going to pick two stocks that look the exact same or that have the same price because it doesn't give you much of a contrast. These will be different. So with Kinder Morgan, this is a cheaper stock at 18, 19 bucks, had pretty good trending characteristics throughout the year. And the setup here is fairly straightforward. I've got a nice little potential high base breakout. So you can see with today's rally up almost 2%, matching the market, knocking on the door of a $19 breakout. That's the pattern. If you take a look at what strategy you could use to trade around it, if I look at the options, implied volatility, remember this little indicator helps me to know if options are relatively cheap or expensive. They're cheap, okay? They're cheap right now. And so, first of all, before you even get fancy with options, this might be cheap enough where you just straight up buy the stock for a little swing trade. 19 bucks isn't all that cost prohibitive. You take a look at the weekly chart. If I bought the stock at 19, I think 20 bucks is doable. And then beyond that, ultimately 22, I think is your big boy target. But I could buy the stock, I guess is the point. Stop under the base or prior day's low, little swing trade. If you want to amp up the leverage, you don't need to get crazy with a spread trade on a $19 stock. The reality is when you look at the options, say you go to July here, there's not a lot of premium in the out of the money options because it's a cheap stock. So in my mind, you either like it enough to buy the stock or buy a call option, or you go find some other stock to play with. So the play here for a little swing trade for me would be like buying the July 18 call, paying about $1.17 or so. Risk is minimal. You hope for this to break out and have some upside follow through, get up, towards 20 bucks or so.
Let me just
So,
kind of highlight this one real quick. So on the
yep.
chart, if you go back to that one for a second, obviously, if you're looking at that trend, anybody can see the just beautiful upward trajectory since November when energy really started to pick up and take off. Higher pivot low, higher pivot high in the trend development just over the last 3 weeks. And energy, the XLE definitely does not look like KMI. KMI has a very different kind of clearer trend in my personal opinion.
Mhm.
And if we look at the 19 level breakout, there's a clear trigger point for a potential swing trade. Being a lower cost stock and lower implied volatility percentage, options are generally cheaper. So you're leaning on simplicity here with just a straight long call option, correct?
Yep.
Got it. All right, got it. Okay, perfect. What do you got next?
All right. So the other one that we liked was PSX and KMI, cheaper stock. This one more expensive. KMI, I think maybe a little bit better for a swing trade. This, because the way the weekly chart's set up, is going to look more, I think, be more appropriate for a position trade. Options are just as cheap, right? So I got cheap options here. So I'm not doing a cash flow play. I'm not selling options. I'm going to do a delta or directional trade. And I think you look at the weekly chart here. This is pretty interesting. You actually have a pretty big cup and handle pattern. And what's interesting about this is the handle itself is a cup and handle. So you got a pattern within a pattern. And obviously this $90 level is some serious resistance. Like this area has been tested multiple times and is an obvious line in the sand that we could build trades around. You guys often say stock breaks 90, it goes to 100. That makes it a nice, easy, obvious upside target. I think it's also, doable. We're not asking that much for a position trade for this to go from 90 to 100. So easy trigger, obvious target, cheap options. And I'm not just going to buy a call option. We can actually build a decent spread here, a bull call vertical spread, buying the 90 call and then selling the 100, which essentially is our target, going out a couple of months. So because it's a position trade, I'm not going to use June or July options. I'm going to go out to August, give it some time. Going to buy at the money, the 90 call. It's basically the trigger point. Got about a 50 delta. And then we're going to sell the 100 call, which is essentially our target. Works nicely because the delta is around 23. So my net delta is going to be around 20, 26, 25. When we like to have a net delta 25 when we build these more directional bull calls. So buy the 90, sell the 100. The cost structure is actually pretty nice on this too. I'm paying $3.30 for a $10 spread.
Mm-hmm.
That means I can make $6.70. So I'm risking one to make two. And yeah, the numbers just work out really great on this guy. So here's your risk graph. You can take a look at that and tell me what you think.
Now, all right. So we've got Kinder Morgan with the July 18 simple call, Phillips 66, the 90 to 100 breakout. Whenever it breaks 90, Matt, we know what the saying is. It always goes to 100, right? Like Tyler just mentioned. We're building it through the 90-100 call spread, which is interesting because then your short call essentially becomes, a function of your targeting as well. It's an interesting, different comparison here. And that's on the backs of just strength in XLE in general, which I guess, Tyler, somebody could just trade the XLE if they chose to, if they wanted that broad-based exposure on the sector. Matt, any thoughts so far as we're breaking down these two different companies?
No, not so far.
Okay, so what do you got on XLE itself, Tyler? If we decided we wanted to go from the individual components and we wanted to go to the sector itself, what would be the advantages? How would you approach this one?
Yeah, so the advantage of XLE versus the other two, you get diversification. So you're playing the whole sector. In the event that there's stocks, company-specific news, maybe Phillips 66 comes out with some adverse news, or Kinder Morgan, same thing. That could torpedo those two, but it won't necessarily torpedo the sector. So generally, the sector play is the more conservative, safer play. Usually you have less volatility. You don't have to worry about earnings announcements as well, right? From a strategy selection perspective, the chart is somewhat similar to the other two. Options are cheap. Where I think you could contrast XLE, Kinder Morgan was the most aggressive with a long call from a directional perspective, we call that like a +3. That's like aggressively bullish. The bull call on Phillips 66 is more of a +2 trade, so that's more moderately bullish. With XLE, maybe I would do like a +1 trade, which is more mildly bullish. And so to give you the contrast, I would build a mildly bullish trade on this with IV being low. Usually that translates into a bull call diagonal spread, also known as a poor boys cover call. The pricing works really well on XLE because the out of the money calls have pretty good premium, and the longer term in the money calls aren't all that expensive. And so there's a lot of variation with how you can build these, but conceptually, I'm not going to buy the stock and sell a covered call. I'm going to buy a call option as a substitute to buying the stock because it's cheaper. And so you could buy any one of these longer term in the money calls and then just sell a short term out of the money call against it. For me, I would probably buy an August call option. I like to go in the money. Got to have a delta at least 60, upwards of 70. But let me go with the 52 strike. It's got a 67 delta. It's going to cost me about $4.75. And then I'm between months here, Tim. So I'm actually just going to go with the 30-day weekly option, assuming it has decent liquidity. And I'm going to just sell a covered call. So I usually sell a delta between 30 and 40, somewhere in here. If I'm a little more bullish, I'd probably sell the 30 delta. I'm a little more neutral, I'd sell closer to the 40. I think I'm going to, let's see, we're at 55. I'll split the difference. No, I won't. I'm more bullish. I'll sell the 57.50. Bring in about 80, 90 cents. That'll cut my cost. And at first blush, it's hard to know what's going on here. With these diagonals, you really got to look at the risk graph to get a picture of the trade. So let's take that one off. All right, so here's what the risk graph looks like of this AUG 52, July 2nd, 57.50, call diagonal spread, $3.91. That'll be your risk. If this heads up towards my strike, 57.50, today I'm up $75. At expiration, I'm up 200. So, we're talking a 20 to 50% potential return, which is really good for a poor boys cover call.
All right, so we got three ideas here, and we can stick right here with the risk graphs. I think they'll flash through, and we saw the chart technical analysis. Obviously, they're all definitely valid. I think that might actually end up being how I make my decision, though, Tyler, because I think all three ideas are very, very valid here. XLE with a diagonalized spread. Some people call it a poor boys covered call. You're going out to August. You're selling the July. You're using the weeklies because the liquidity really is there for XLE. You can use the weeklies here. The spreads are still tight. The open interest is still there. So they're viable. They're in play. Kinder Morgan with the simple trade, the July 18 call above resistance, and Phillips 66 on the 90 breakout to 100 on a bull call spread. I'll tell you, the one that stands out to me that I like the best, and is really because of why I like this chart. Go back to the chart for a second. Phillips 66 would be my choice. Okay. Phillips 66 would be my choice. Now, what we're looking at here is we're looking at a daily chart that has been in development now for the better part of about 3 or 4 months, and banged our head at 90, came all the way down, dropped below the moving averages, fired back, showed the technical response off old resistance. Now we've put in a cup and handle pattern on the daily. Higher pivot low, pushing towards that resistance, real strong price response this week. But when you couple that with the weekly chart, Tyler, this is where even because all three option strategies are valid and viable here, right? But I love this weekly chart development. I really see it. I see the pattern. I see the trend. I see the price action. I see the old resistance points coming into play. I see round numbers that make sense to me based on the way I've traded over the course of 16 years. I would stick with Phillips 66. Bull call spread out of the three, it's one I like the most. Maddie, what about you? What are your thoughts on Jedi options here in these three different potential option plays?
It's always a good discussion to talk about how to approach a sector when a sector's starting to show some love and waking up with the breakout that energy is doing, and the swing trade on Kinder and the position weekly analysis on Phillips 66 or the diversified approach on energy. The beautiful thing about this type of breakout is there really is something for everybody out there. And that's what I loved about this segment today.
Ty, which one do you prefer out of the three? You like them all?
I honestly, I'm partial to the more conservative one. So I would do XLE of the three. I like them all. I probably like Kinder Morgan the least. It's just a cheaper stock. I tend to trade the more expensive stuff with spreads. So XLE first, PSX second for me.